clap it.
Clap.
Yeah. Okay, guys, let's coordinate this again, once again. Okay, let's try it again. Good stuff. So tonight, you know what, we're gonna chat about business owners and what matters to business owners and some of the solutions that people can use to figure out how to reduce their tax inside the business.
Let's do it.
Let's do it. I'm
That
excited.
sounds good. That sounds great.
Great. Sounds good. Business owners, this is for you.
Yeah.
Business owners, this is for you. So what do you guys know about Canadian tax system when it comes to personal versus corporate tax and relation between the two?
Especially once you get into higher tax rates, your marginal tax rate gets higher. It's pretty stringent. It's putting a lot of stress on Canadian families, I guess you could say.
Taxes, that's right. What do you think?
Well, what I do know about the difference between the two is that for Canadian business owners, tax and regulation is oftentimes cited as one of the biggest obstacles in running their business. So outside of running your business alone, you're trying to figure out how the heck am I going to pay these taxes?
Yeah, exactly. So if you're a business owner, there are many hindrances, many obstacles actually that you need to jump through. But three of them that are common for actually moving forward in business and preparing yourself for the exit out of the business, preparing for the retirement and stuff like that is taxation. Taxes are pretty high on a personal level. Taxes, if not structured properly from the corporate side, are very high as well. Second one is inflation. Canadian inflation is about 3%, 3.1% on average. So looking over the last 100 years, that's right, again, like 3.1%
on average.
So when you think about it, if you have only tax and you have only inflation to worry about, nothing else, 3.1% for the inflation taxation on a personal level if you're a high income tax bracket. So let's say if your income is over $200 or let's say $300,000.
Get tax 40%.
That's in Alberta. Other provinces are higher.
Yep. Higher.
So if you look at the taxation for high income earners, half of the money above a certain threshold is going to go to the government.
Wow.
So 50%.
Network.
You know what? If you make, let's say, 300 grand or 400 grand, anything that's above 300,000, I'm using round number because it's a little more than 300,000, but 50% of that money is going to the government in the form of tax, income tax, as simple as that, right? So think about this. Let's say, for example, if you want some safe investment, you don't want to take any risks, because your business is risky and you want to put money aside for the retirement. And let's say you make 5% income.
Yeah.
And if it's income, so inflation is going to eat 3.1% on average out of those 5%. So where you left with?
Negative.
No, you're 1.9. And then when you think 5%, earnings, 50% of that is tax, 2.5%. So 3.1 plus 2.5 ends up being 5.6. So you're negative actually on, let's say, GICs or some of the guaranteed investments that will give you yield of, let's say, 5%.
Yeah.
So it's called going broke safe.
Going broke safe. Yeah, that's right. So the key is you need to figure out certain strategies. There are lots of strategies when it comes to financial planning to reduce the taxation.
Okay.
And we're going to talk about it. The third biggest obstacle is no plan. Somebody wise said, if you don't have a plan, if you don't know where you're going, any road will do. You see, and that's but you know what? You want to know where you're going, so that not any road will do, but actually that you get to your destination. And whatever your destination is, you got to figure out how to get there.
Absolutely. And most business owners are always encountering surprises. And if you're choosing any random road, you're definitely going to be encountering surprises along.
But you can plan for those surprises, right? You can plan for those surprises. There are ways around them, but
that's
you can't
you can plan for the surprise.
Plan for the surprise.
If you're not planning, you're going to get surprise. Huge tax rate, inflation is going to go nuts and whatever. And obviously some things are going to fall through, and whatever you didn't account for, it can bite you in the butt.
You know what's happening? Like over the last maybe 7-8 years, almost 10 years, the government's been attacking people who are business owners, saying they have unfair tax advantage. So if you want to shelter money inside the corporation and stuff like that, they started closing some of those things. I don't even want to call them closing the loopholes, because they're not loopholes. That's simply how it was. So let's even the playing field, even out the playing field for the business owners versus employees. Well, who's going to even out the playing field when it comes to the risk?
Yeah.
You know, because an employee and a business owner, they don't have the same risk.
Not at all.
You know, 8 out of 10 businesses typically fail.
Yeah.
That's North American statistic, both for Canada and United States.
Yeah.
So 8 out of 10 fail. So where's the benefit for running your own business and taking the risk that there is 20% chance that you succeed? 20% chance. If you start the business,
And if you start to succeed, then there's an expectation that you're going to bring other people with you.
absolutely.
Oh, you're going to hire people, right?
That's right.
They'll ask you, you plan on hiring people, right? You plan on growing, right? You plan on contributing to the economy, right? So everybody's always looking at a business owner to save them, including the government.
That's right.
The government's looking at business
Small
owners.
business, big business, it doesn't matter, you know. So,
Yeah.
but anyways, we deal with what we have, and you know what, you cannot straighten crooked things, and you know, whatever you think of the government, I'm not gonna go into the politics. I have a lot to say, but I'm not gonna.
Yeah, that's good.
That's right. Yeah.
Next episode.
But so here's the challenge for the business owner. Let's say if you incorporate a corporation. Corporation has a certain particular taxation, which means the active business is taxed one way, passive business income is taxed a different way. So let's say Alberta, for example, active business for income that earns up to $500,000, not earns, but profits up to $500,000 per year, active business income is taxed at 11%. Passive income, which means, let's say, if you hold real estate and you don't run, let's say, a real estate management company, but you just buy real estate for your own purposes, any income that you get from real estate is considered passive income. And passive income is taxed inside the corporation at about 50%. So active income is 11%, passive income is 50%.
Mm-hmm.
So how do we bridge the gap, right? Like what do we do to shelter those things so that income, so that you don't part with 50% of the money that you earned inside the corporation and put it in investment for future purposes, right?
So what actually makes up passive income? What's the true difference between active versus passive
So
income?
active business income is income that you make as the operation of your business, as the core operation, core income of your business.
Yeah.
So let's say, for example, if a person is an electrician or a truck mechanic or a doctor, physician, blue collar, white collar business, whatever is the primary business, that's the active business. So invoicing that, let's say, electrician gets, invoicing that mechanic gets, invoicing that physician gets, that's active income.
Okay.
But once you earn the money, and more often than not, business owners tend to keep the money inside the corporation because they don't want to pull it out and get personally taxed, heavily taxed, right? So they keep it inside the corporation. They decide to put the money, let's say, into mutual funds, into stock and bond portfolio, into real estate. Those are the most common things that people put their money in. Now that's
And they're doing that all within their corporation.
all within the corporation. So it's corporation that invests in those things. So that's all passive income.
Okay.
So let's say rent. If you buy real estate with your corporation,
And you're charging rent.
you're charging rent.
Consider
Rent is
income.
passive income, and that's taxed at 50%.
Yeah.
After the expenses, of course.
Yeah.
That's taxed at 50%. Yeah. Let's say you buy some mutual funds, and let's say they're conservative mutual funds consisting mostly of bonds that yield certain percentage. That's passive income as well.
Okay.
So there's a coordination between, interest income, capital gains income, dividend income. So they're all differently taxed,
Yeah.
but they're still taxed very high. Okay. And
Higher than active income. At least.
much higher than the active income. And even now, so in 2024, there was an announced change for the taxation of the capital gains.
Yeah.
So capital gains were taxed, only half of the profit from capital gains was taxed. Now it's 67%. So it's 2/3 of capital gains that are taxed.
This is after the first 250.
That's for a person individually. When it comes to the corporation,
the whole
it's from
is
the
two-
first dollar, you're taxed 2/3. Now, that has not been passed as the law as of now, so January 2025.
Yeah.
But CRA already started implementing that ruling, even though we don't know yet if it's going to be
Really still assessing.
that's right. Yeah, so it's still being assessed. Maybe it passes as the law in March or April,
Yeah.
but CRA started applying. So so that's what people are doing. So on personal side, first $250,000 of capital gains is taxed 50% inclusion, so only half of the money is taxed.
Yeah.
About 250, 2/3 are taxed, but on the corporation, so for a business owner, from the get-go, 2/3.
Wow.
Yeah.
That's crazy. That's crazy.
And that's the lowest. That's the cheapest tax-wise form of passive income.
Well, it's the cheapest, yeah, because dividends are taxed higher, and interest insurance is that's right, taxed even more. So you see, so there are many challenges. In particular, when it comes to planning, you gotta plan for your business to avoid the taxation.
Yeah.
I bet that 9 out of 10 Canadian business owners don't know that at death, if they don't have proper plan, if they have a corporation and business that's going to pass to their estate, let's say their children or whoever they would leave it to, there's potential for double taxation.
Yeah.
You see, so it's there's terminal tax, at death. So they have to file, let's say, for example, if person is male, we'll just use he in this case. Some people get offended by, like gender equality and stuff like that.
Not you though.
No. Let's say, okay, let's switch. If the lady is a business owner, okay, so let's say business is worth $2 million at death.
Yeah.
Okay. And let's say there are $2 million of assets inside the corporation at death. So let's say cash portfolio that was invested 20 years ago. So there's lots of taxation, right? So first, the growth of business from 0 to 2 million is going to be taxed as capital gains.
Yeah.
Right. So with the current change, 2/3 of the money is going to be included and taxed at 50% rate. So $2 million
Right off the bat. It's
right off the bat.
taxation, yeah.
Right off the bat. So we're looking at $1.3 million included in taxation.
Yeah.
Business $2 million.
Yeah.
Half of that, so $600,000, more or less 650, is going to pay the tax.
Just tax. Well, it's probably important to note what deemed disposition is, like how it's getting taxed.
Well, in terminal, it's considered as if you sold your business.
Like before.
Terminal means the death tax filing.
So if you don't name a beneficiary,
Even if you name it, going to the estate, there is a capital gains. You see, as if you sold the business.
I see.
Yeah.
I see.
So it's as though you had income in that year, but the income at the end of the year of your death was you sold everything that you owned.
Yeah. So essentially, corporation is transferred to the estate. Let's say the business woman's kids inherited the business. Now the business has $2 million inside the corporation.
Yeah.
First of all, they need to take that money out.
Mm-hmm.
You see, because if they're not going to operate the business, they gotta take the money out. Now they're getting taxed on that money being pulled out.
Yeah.
Full amount.
Yeah.
Full amount.
Being withdrawn
So
from the corporation.
money is withdrawn from the corporation. $2 million. Remember, that's the worth of the company. So just for this sake, it's $2 million. Now there is $2 million of dividend income that's taxed in their hands.
Yeah.
And
Which
that's probably
is even higher than capital gains.
capital gains. So we're looking at $2 million at roughly about 40%, more or less, 37, 38%, depending on the province, 40%. Let's use 40 just for easier calculation. What's 40% of $2 million bucks? 800,000. And we already had almost 650,000 before. So do the math.
So 1.4 million as tax, 2 million
On $2 million business. So it's double taxation. If you are dealing with real estate, it's even worse. There's triple taxation.
That's crazy.
So if you live in Ontario, about 83% of the corporate value, if you were dealing with real estate, would go to the government.
That's crazy. That's crazy. And nobody in their right mind should look at that and say, oh, that's completely fair.
No, 80% of your life's work is just gone to the government.
And that's the default setting. That's the default setting without any plus.
So obviously you can mitigate that risk, but the government's going to take full advantage if you don't.
If you don't plan, they're expecting, hey,
they're expecting your entire business to go to them. Nothing's fucking left. And then people have to sell their own homes, or they have to sell whatever their other belongings are.
their interests intact.
Exactly. So there are ways to mitigate that and to reduce it significantly, but you got to plan.
Yeah.
So the problem of not planning it is that you may get double taxation or potentially even triple taxation.
Yeah.
Right. So you got to plan. Surround yourself with the professionals who are going to help you plan. Lawyers, accountants, financial advisors, whatever your team is, right?
Well, if you plan properly, you can even transfer some of that passive income tax to active income tax as well.
You can.
You can figure it in a way.
There are ways around
that business properly. Yeah.
Exactly. But if you don't structure, if you don't plan, you're going to be hit with tax big time.
Yeah.
Big time.
Yeah. And that's just choosing a random road as the example.
Exactly.
That's a surprise you had at the end of the line.
Yeah. And it's a guaranteed surprise. It's a surprise that you should know.
Your reward for all of your hard work is I take all your money.
Yeah, that's the around trip.
There was that the joke, about the new proposed income tax form from CRA. What was your income in 2025? Next line, send it all.
Send it. And then you're in the clear.
You're in the clear. Good.
Yeah.
That's just safe. Yeah.
So the question ends up being, okay, what are the ways to reduce the taxation, right? And the most common ways people approach it is, okay, we pull the money out as T4 income, which would be employment income, pay tax, pay CPP, and whatever money we don't need to use, up to 18% per year, you put into the RRSPs, and it's deducted from your overall income. And the RRSPs grow on a tax-free basis while they're inside the RRSPs. And when you pull them out, you get taxed based on the amount that you pull out. So that's one way.
This is income in your hands. What is your risk?
That's right.
Environment.
The big conversation that the people often ask, okay, should I pull T4 income, which is employment income, or should I pull the money out of my corporation as dividends?
I see.
Dividends are slightly more tax beneficial if you pull it out, but there's a coordination between corporate tax and personal tax on the dividend side for your business. So it ends up being more or less the same, within 5-6% of what T4 income would be.
I see. So is that just because of how it depends how you're pulling it out, like dividends from the corporation?
Dividends from the corporation. So the benefit from the dividends is, some people see it as benefit, others don't, that you don't need to pay CPP. You see, so Canada Pension Plan, you don't need to pay contribution, neither your personal nor corporate, which ends up being about 8,000 per year combined, like somewhere in that.
There's like 8-9. In your experience, was that desire to pull out versus T4 versus T5 income specifically due to CPP? Who's decided?
It's up to you, to personal preference. You see, and there are benefits to both. You see, because if you have a T4 income, you have the RSP deduction. and you get RSP room to invest money inside your RSPs.
So build RSP contribution.
You build RSP contribution room. The benefit of the RSPs, once you put the money inside the RSPs, they grow tax sheltered, right? You see, until you withdraw them.
Yeah.
Right. The other option, so if you take the income out as dividends, you don't get the RSP room. Okay. You don't get the income, but you don't get charged CPP as well. And the challenge with the dividend income is if you want to take personal loans, the banks don't look as favorably on dividend income as they do on T4 income. It's not that it couldn't be worked around. And many mortgage brokers or loan brokers, they're fine and they can do miracles from that perspective.
But may go through a little bit more of a headache.
Exactly. And not every bank would maybe want to take you as a client because of that, or maybe that's a amount of money.
What's the reason behind that?
Reason is because it's not declared as income, but as investment, not earned income, but as investment income.
So you see, they perceive it as less secure.
Less secure. That's right. Yeah. So that's the benefit of T4 income versus T5, or like a drawback from the other perspective.
And that's the traditional method.
That's the traditional method. Yeah. Now, for business owner, you see that threshold of money crossing from business into the personal hands, that's the highest income tax event.
I see.
You see, so many business owners tend to leave the money inside the corporation.
Yeah. Generally out of fear of not, or just knowing what's going to happen, but not knowing what to actually do in that situation.
Even from the tax perspective, you see, because if you pull the money out, you get dinged, 40-50% of that money versus you leave it inside the corporation. And passive income will deal with the passive income. But there are ways to mitigate the passive income as well.
Yeah.
So it's, we'll talk about.
So a lot of business owners are choosing actually not to pay them, at least on paper, not pay themselves very much at all.
That's right.
I see.
Yeah, and keep the money inside the corporation.
And spend usually what's on the business. They're still spending it on their business. That's their lifestyle. Practice.
Exactly, yeah.
But they, they're
even for their future, they would leave the money inside the corporation, you see. Now, and that's where the challenge of the passive income comes.
Yeah.
Higher taxation of passive income.
Right.
Yeah.
Passive income is not only higher tax rate. Passive income also reduces your small business deduction.
What is that?
So if your business is up to $500,000 profit, okay, first $500,000 is taxed at 11%.
Okay.
After that, depending on the province, Alberta 23%, other provinces 27-28%. So pretty much doubling or more.
Yeah.
Taxation.
For and after $500,000.
After $500,000. That's right. So first $500,000 is small business deduction.
Wait, sorry, in profit or total revenue? In profit.
In profit. Only profit.
Oh, okay.
Yeah. So revenue is one thing. Even if you have $100 million revenue and $500,000 profit, you'll consider it small business and you're taxed at 11%.
Huh. Okay.
You see.
But that's all
it's
within
only
the
profit.
corporation, though.
Yeah.
Within the
That's within
corporation. That's right. But you see, if you have passive income, so let's say you operated for 10, 15 years, you accumulated significant amount of money, and you're investing your cash inside the corporation. And let's say, for example, you accumulated $2 million and invested them in GICs earning 5%.
Yeah.
That's $100,000 of passive income.
Wow.
You see?
Yeah.
So first 50 grand, like everything is taxed at 50%. But first $50,000 don't affect your small business deduction.
Okay.
The second $50,000 of the $100,000 of passive income reduce your small business deduction from $500,000 to $250,000.
And is it because that passive income that's assessed above that amount is accounting for more dollars that go against the small business deduction?
So they will reduce. So for example, for every dollar of passive income above $50,000 per year that the corporation has, your small business deduction is reduced by $5. So for 10 grand, you lose $50,000 of small business deduction. So it drops to 450. For 50 grand times 5, 250,000. So your small business deduction is not $500,000 anymore.
With passive income, it's 100.
Active income of $500,000 is not $500,000.
It gets reduced.
Only 250 is at 11%. Above 250 gets taxed at a higher tax rate. 20% in Alberta, in other provinces 27%.
If the income didn't have any active income component, it was all passive income, you'd be wiping out a small business deduction pretty quick.
Completely, yeah.
So 150 grand, right?
150 grand
Would you wipe it out in
passive income. Also, let's say income, I've seen in my industry been doing financial planning for almost 25 years.
Yeah.
Okay. Having $3 million for many business owners inside the corporation, especially if they're approaching retirement, is nothing.
Right.
You see, it's kind of like normal. That's normal to see. So think about it, 3 million, and let's say 5% GSC. Just investing it in a safe way. Not even looking at the inflation or anything like that. Not even looking at the taxation of that money inside the corporation. Only the effect that it would have on your small business deduction.
Yeah.
And let's say you're still operating that business.
Yeah.
Okay. So first 50 don't affect you at all.
Okay.
But then the second amount, like $100,000 above that, because from 3 million at 5%, you're earning 150 grand, you would lose the entire small business deduction, all of it. So your active business, instead of paying 11%, now would be paying, depending on the province, 25%, 27%, 23%.
So people need to find a way to separate their active income from passive income, essentially.
Yeah.
So what are some strategies of doing that?
Well, first, corporate structure is extremely important.
Okay.
Right. It's fine to have just operating corporation to begin with. And there are more tax issues. I didn't even mention those. We'll maybe talk about them.
It's a big top.
It's a huge topic. We need an up now, yeah.
So structuring your business affairs properly is the key, you see. So those structures could be, I'm just throwing options, having a second corporation which would serve the purpose of your holding corporation.
Okay.
Where all the passive income assets will go.
Okay.
That's separate entity, you see. Or setting up a family trust that would hold, let's say, that second corporation.
Yeah.
And removing it from the active business so that the active business is not affected by your passive
deduction is intact. And
that's right.
All that.
So that's kind of like that structuring issue. But still the passive income, even if it's inside your holding corporation, is going to be taxed as passive income. So there's no running away from
you can't
that
escape it,
unless you use certain strategies.
And what we just described, that it only takes $150,000 to wipe out the small business deduction, that issue still arises, especially arises in that case with the holdco.
That's right. Yeah. So I would say the way when I look at a business owner, in my opinion, there are three things, three strategies that all business owners should seriously consider. Even I would say everybody should implement this if possible.
Okay.
So one would be individual pension plan or IPP.
What's that?
So IPP, you know how there's RRSP for individuals?
Okay.
So whatever your earned income, let's say if you have earned income of $100,000, you'll get $18,000 every year that you can put inside the RSPs. It's going to deduct your income. So your income instead of $100,000 for tax purposes is going to be $82,000.
Yeah.
Okay.
So it's a defined contribution plan. You have a contribution that you're allowed to give each.
Contribution is based on your income and based on the percentage, right? And the maximum contribution for the RSPs.
I see.
Okay. Individual pension plan is similar to that, only operated and run by the corporation.
Okay.
And it's based on the RSP room that the executive or the owner of the business has declared on his or her T4 income.
Okay.
So let's say, for example, if a person gives him or herself $100,000 income, ST4 income outside of the corporation.
Yeah.
Okay. They would get those 18% from the RSPs. That would be their room.
Okay.
They would have an option. Pull that money out and put it into the RSPs.
Okay.
Or have the corporation invest into individual pension plan, IPP. Okay. If the money is invested into an IPP, it becomes tax deductible to the corporation.
Okay.
It's not taxed to the person who the beneficiary is, so business owner, executive, or whoever the person is.
Yeah.
Okay. And it's creditor sheltered. So it's creditor proof, you see.
So this is funded by the corporation.
It's funded by the
corporation, right?
not by the individual.
If hypothetically the business goes bankrupt, the IPP is fine. It's
Yeah, if business goes bankrupt, because when individual pension plan is set up,
okay.
it's set up as a trust.
Okay.
In trust for the beneficiaries.
I see.
So the business owner is one of the beneficiaries. There could be multiple beneficiaries. There could be a group of
Executives.
like a smaller, of course, group of the executives that would share in the same individual pension plan. So husband and wife, let's say, or husband and wife, and they're employed in the business children, right? For let's say adults or whatever it is. Right. So they would all generally share, but it's a trust that's separate from the corporation, separate from them individual.
Okay.
So even if there is corporate bankruptcy, this is sheltered.
Okay.
If there is personal bankruptcy, this is still sheltered.
I see.
You see, nobody can touch it because it's a
creditors can come for RSPs, right?
In some cases, creditors can come to the RSPs depending on how it's set up.
Yeah.
And in Canada, depending on the province. So different provinces have different regulations, but in general, the answer is yes.
Yeah, because it's individually owned, right?
Exactly.
At a separate entity, it's like a corporation, right? Like creditors come for that entity, not the person specifically,
Yeah.
right?
So that's what IPPs do. They shelter essentially, now it's like RSPs. Okay. So when the money is inside, whatever the growth is, it's sheltered from the tax.
Okay, I see.
Until you pull it out, of course.
Now, is that something that somebody could pair with an RSP? Could you have an IPP?
You can have an RSP and IPP.
You can, okay.
Typically, what I recommend to individuals or business owners is merge them and put them all inside the IPP.
Okay.
Because you can roll your RSPs into the IPP when you set it up.
I see.
So it's very common that the person was using RSP as the vehicle.
Okay. Yeah.
And then, hey, you know what? They learn about IPPs 15 years down the road.
Yeah.
Okay.
They're like, okay, what do? I have money inside the RSPs. I have an IPP. You can merge them together into the IPP.
Okay.
Now, actuaries would do that. So it's not like the RSPs, like straightforward. No, there's an actual calculation, actuarial calculation that needs to be set up for
See how you
for an IPP.
Does that mean that there's past year service contributions that are allowed for it then?
Absolutely, yeah.
Wow.
Yeah.
So if you didn't discover about the IPP, whatever, 10, 15 years into building your company, you can add later what
you can add later.
Yeah, okay.
So let's say even, for example, you had lots of T4 income but never put money into the RSPs.
Yeah.
And let's say there's $200,000 room for the RSPs. You would see that on your notice of assessment.
Yeah.
Okay. You can merge that with the future planning actuarial calculation.
Yeah.
How much needs to be contributed into the IPP.
Yeah.
Okay.
So corporation can put, let's say, those 200,000 that were inside the RSPs plus additional whatever actuaries calculated.
Yeah.
The entire amount could be put into it and become tax deductible to the corporation.
So you can play catch up with an IPP basically. It's defined by the amount of distribution room you've accumulated.
Exactly.
Okay.
And what's very typical with the IPPs, not typical, but that's pretty much in every case that I've seen, when the individual is over 40 years of age,
Okay.
they have significantly more room
Right.
than they would with the RSP.
RSP, yeah.
Because RSPs are limited to 18% of your earned income.
And for a lot of these people, it's just not enough.
It's 18%. You see, so it grows. It's over $30,000 right now. I remember when it was under 20,000. So it increases with the inflation, but it's that 18% number. And that's it.
Yeah.
With the IPPs, because it's kind of like there's actuarial calculation to it. So there's defined, it could be defined contribution, defined benefit. However it's structured, there is more room to put more money because of the needs. And it could be even recalculated. If the markets go down, and let's say whatever is invested in the IPP goes down, there's just correction in the market. Let's say the investment was a stock portfolio, then there's potential to get even a higher contribution.
Or you can add the losses.
You can add the losses to the contribution bonus. So again, there is actuarial calculation.
Yeah.
So it's not straightforward plus minus.
Yeah.
But there's a calculation.
And you can't do that with RSPs.
No. RSPs are based on your taxable income.
I see.
So this is based on the amount that's needed to fund your retirement.
I see.
You see.
I see.
Yeah. So RSP, just to simplify, it's based off of current income.
That's right.
So that's what a defined contribution pension plan is, right? They define the benefit before.
They define contributions. That's it.
Either what you allowed
could be used as defined benefit, which means how much money do you need to have in retirement to match your current income, you see? And then actuarial calculation can vary. And in the correction year, like in bear market, when the markets drop down in stock markets, more room could be created for additional contributions.
I see. Yes. So RSP, defined contribution, IVP, defined.
Yeah, I wouldn't call it defined contribution. It's just contribution because technically it would not fall. They're pensions with the defined contribution.
Okay.
So but wouldn't call it for the RSPs that
But it's
way.
based off contribution.
But it's based on contribution.
Whereas IPP is based off of benefit.
Yeah, exactly.
So you could set an IPP as well to have set annual contribution.
You can, of course you can. Yeah, an initial actuarial calculation is going to do that for you.
Okay. So as a separate entity, you get creditor protection. Given that it's funded by the corporation, you can deduct the expenses
to the corporation.
To the corporation. But it's usually the business owner.
But expenses are deductible, so there could be setup fees, accounting fees, all that kind of stuff. Even if it's $1,000, $2,000 or whatever to have it set up, that's tax deductible.
Right. Oh wow! So including any expenses related to setting it up.
Exactly.
Wow. Yeah. Okay.
And since RSPs for a lot of these business owners that we're talking about aren't usually enough for retirement, this is just like an extra additional pension plan.
That's right. It serves the purpose instead of RSPs with slightly more room.
Okay.
There are other things that to top up because you still have a ceiling with the IPP.
Yeah.
So it's a little bit higher than RSP ceiling.
Yeah.
But there is still a ceiling.
But with that past year's contribution, with the past year contribution, you can even maximize even further, right?
If the market drop, you mean?
Yeah.
Yeah, of course. Yeah.
It basically means that if you it gives you more freedom to have the kind of retirement that you would want as a business owner that matches your current lifestyle than with just RSPs alone.
Yeah.
And you see another benefit. Let's say, for example, RSPs. Husband and wife.
Yeah.
If let's say one of the spouses passes away, the other spouse becomes beneficiary.
Okay.
And there is no tax event. The tax event is when the second spouse passes away, and then the full amount is taxed. So let's say if there was $1 million inside the RSP's investment, when the second spouse passes away.
Okay.
Then the entire amount is taxed in the hands of the estate. So 50% of that money goes to the government. Wow. Okay. Even if first spouse passes away, did not put the second spouse as the beneficiary, it's taxed again, unless something is done retroactively. You see,
crazy.
With the IPPs, let's say, for example, business, it would be the same situation when the second spouse passes away. However, what sometimes could be done, and this is what sometimes I recommend to people, is if you have your kids working inside your business, adults, put them as members of the IPP as well.
Okay.
So when you pass away, they're still the beneficiaries. There's no taxation on
Because they're
if
also
that-
beneficiaries.
they're beneficiaries. So the pension plan just stays the way it is,
and just
and they're benefiting from it. So
it's not even a rollover.
it's not
used to
rollover.
exist and
It just continues
current-
existing. One of the beneficiaries or two of the beneficiaries passed away.
Yeah.
There are three other beneficiaries. That, if there are three kids,
Yeah.
they continue both contributions and waiting for their retirement for the income from the retirement.
So if you have you run a family business,
Yeah.
and you're trying to pass over your wealth to the next generation, one of the best ways to develop wealth is with generational wealth.
Yeah.
That's right.
It's an incredible tool for that. Then
Exactly. It's amazing.
it is the tool for
Because you don't need to. It's with other tools that we're gonna address now.
It's at least number one that you absolutely must consider.
Yeah, that's one that
Yeah.
must be considered.
Yeah.
Now, you see,
In your experience, Dad, did you notice a lot of business owners that already knew about IPPs or knew this?
very few business owners know about IPPs, and many have heard,
Yeah.
but don't know any details or how it works, how it
So-
operates, and stuff like that. It's just kind of like, hey, you know what? I heard about something like that.
Yeah.
Just like RCA, which is retirement compensation arrangement,
Right.
Yeah.
which is another tool for business owners. I'm not going to go into details here, but very, very few people heard about it.
Mhm.
And whatever the tax benefits and tax drawbacks are of such setup.
Right.
Yeah.
So,
Well, that's the whole purpose of our seminar or workshops as well.
Yep, we're going to talk a lot about that. So if anybody's interested in seeing a live seminar where we discuss all of these strategies in depth and can answer any questions, feel free to sign up for it.
exactly. So, second strategy that I would say that every business owner should implement from the financial planning perspective inside their business and saving money for retirement or for the exit strategy for themselves or for the estate planning, because these things are events that are going to happen
Right.
sooner or later. Everybody exits from their business, either at sale or at death,
Correct.
Yeah.
or they close the business and business fails. But
Yeah.
everybody exits eventually. There's a tax man,
Right.
you see. And everybody dies eventually.
Yeah.
So with the estate planning, that's inevitability. There are tax events. So you got to plan for those.
Right.
So I would say the second strategy that every business owner should consider is using permanent insurance
Okay.
to shelter money from passive tax, from passive income tax.
Okay.
So there are two types of permanent insurances, or if you can talk about it, so there's permanent and term insurance, just to simplify.
Right.
Term insurance, term 10, term 20, pretty much you pay for the insurance. When you stop paying it, the insurance ceases to exist. It's done. Whatever you paid, it's gone.
It's for like 5, 10, 20-year period.
20-year
or
period,
Whatever.
and there's purpose for it.
Absolutely.
Buy-sell agreements, let's say for business owners, or
Yeah.
to guarantee loans if the business needs a loan from the bank and stuff like that, right? Permanent insurance, universal life or whole life, is completely different animal.
Yeah.
So with a typical permanent insurance, be it universal life or whole life, they have the cost of insurance.
Okay.
That's what goes into the premiums,
Mhm.
plus the investment component.
Okay.
You see. So with universal life, you have typically annual term insurance
Mm-hmm.
or term to 100, which means the price of the insurance is fixed for, let's say, to the age of 100, or pay the insurance, pay it up in 20 years. Like there are different options there. And then the rest of the premium goes into your chosen investments.
Okay.
Typically, it's exchange traded funds or ETFs.
That would be for universal, like
Universal life, mutual funds of different kinds. So most of Canadian major companies have many, many different options for the investment purpose.
Okay.
Now, why we talk about it is because the investment portion inside the permanent insurance is exempt from the taxation.
Okay.
Okay, so what happens is any growth that occurs inside the insurance is not taxed as passive income.
Okay.
Is it ever eventually upon withdrawal?
We'll talk about it. So yes, there are potential tax events.
Yeah.
Okay.
Potential.
Yeah.
But let's say at death, money goes into the corporation, creates what's called a capital dividend account, which is a tax-free account, and money goes to the estate on a tax-free basis.
And just to clarify, this universal life policy would be owned by the corporation.
It would be owned by the corporation.
And it would be for, let's say, the owner.
Let's say executive, like the owner of the corporation, is the life insured.
Okay. Okay.
Or any other key person from
And the beneficiary would be the corporation.
Corporation would be the beneficiary.
Okay.
Yes. So in Canadian tax law, when it comes to the taxation of the insurance is a tax-free benefit.
Okay.
And if the corporation is the beneficiary of the insurance, then there's what's called capital dividend account that's created. That's a notional account, so it's not like a bank account.
It's not a real account.
No, it's just accounting on paper. It's a line on in the account.
Okay.
So capital dividend account is room inside the corporation that allows corporation to pay money outside of the corporation on a tax-free basis.
So
essentially, no, just don't worry about it. You don't need to worry about it.
How is this? Then it's just money that flows out of the
money that flows. Corporation.
Yeah.
Capital dividend account. That's kind of like part of the corporation.
Yeah.
It's kind of like a door, like a gate, for money to pass through on a tax-free basis.
I see.
You see.
So whatever the number is under the CDA, the capital dividend account, that's how much money can flow out of the corporation tax-free.
Wow. Wow. So, and they can pay that out to anyone? They can pay that out to a shareholder,
estate, family members, whatever it is.
Okay.
So insurance is, life insurance is one way to generate it.
So let's say there's like death benefit on insurance of, I don't know, $2 million.
Yeah, let's use $2 million
or whatever.
So insurance company pays $2 million to the corporation.
Okay.
CDA of $2 million. I'm using round numbers because there's a little bit accounting calculation what that CDA is. So it's not straightforward full amount, but there are certain calculations. CDA account, capital dividend account of $2 million is created. So cash goes from the insurance company into the corporation.
Yeah.
This notional account opens the room of $2 million.
Yeah.
It goes through this to the estate on a tax-free basis.
So they get the $2 million from the death benefit. They get that tax-free.
Tax-free.
And then all the money, the CDA is opened up by that $2 million.
By $2 million. So let's say...
And then $2 million can flow out of the corporation tax-free.
That's right.
On top of
So for example, let's say if you have let's use that universal life. Okay. So you set up universal life policy.
Okay.
You run it for 10 years.
Yeah.
You have insurance of, let's say, $2 million.
Okay.
And then you accumulate $2 million into that investment account.
So an additional $2 million.
Additional. Let's call it additional. I don't want to go into the technicalities of the insurance to confuse you or people or whatever.
Yeah.
You know, so you have $2 million death benefit. You have $2 million investment inside that universal life. So that's $4 million of total death benefit. Yeah. So your investments that you put there that were sheltered, now they fall under the insurance part.
Yeah.
So that creates $4 million of capital dividend.
So yeah, sorry, just for more clarity then, in most insurance cases, the insurance policies that are building up investments or have like an additional number in there, does that also get paid out tax-free? Usually? Okay, so then like in the corporate case, if there's corporately owned insurance, then that death benefit and the investment portion of it gets paid out. All the insurance free, opens up the CDA for $4 million to flow out of the corporation.
That's
tax free.
Tax free. That's right. Well, if you think about the other investment, let's say, say mutual funds, that are held inside universal life, but now they're just held simply standalone, outside, unrelated to the insurance.
Yeah.
Because you have same investment options inside universal life as you do with mutual funds, let's say, or index funds or anything of that exchange traded funds, right? That investment, if you accumulated the same $2 million outside, and let's not even look at the passive taxation, like passive income tax, right?
Okay.
Just look at the estate side. When a person passes away, that money is the assets of the corporation. There's no CDA for it.
Yeah.
Now that gets taxed at 50% because you need to pull it out in the hands of the estate.
Right.
So out of $2 million, you got to pay $1 million in tax, or the estate is going to pay $1 million in tax. While with the insurance, it flows through to the estate on a tax-free basis.
Wow. So can you borrow against this cash?
So there are two strategies that are used. Typically, the accumulation inside the insurance policy could be for the retirement purposes. Okay. So let's say a business owner has in place a universal life policy with the investment.
Okay.
It's in insurance world, it's called cash surrender value.
Okay.
So let's say cash surrender
investment portion.
that's the investment.
The cash surrender value.
Cash surrender value.
Okay.
So let's say if the cash surrender value is came to, let's call it $700,000. Well, let's use million just for to use a round number. So cash surrender value of your investment, but inside universal life, so it's sheltered, is $1 million.
Okay.
And you're at the age of 65, you want to retire, and you want to use part of that money beside your individual pension plan, you want to use that for the retirement.
Yeah.
What people do is they would set up series of loans.
Okay.
So you have $1 million here,
loans.
typical bank loan, using the insurance policy as a collateral.
Okay.
So the cash surrender value as a collateral.
Yeah.
Okay. So they would set up 20 annual loans. Okay, like over 20 years.
So they say we have from 65 to 80.
So, 65 to 85, 75 to 95 depends. Like most business owners tend to work a little longer, because they enjoy their business in most cases. So you set it up over 20 years, and let's say it's 50 grand. Let's forget about any growth. Just use, we had $1 million. We want to take $50,000 per year over the next 20 years.
Mm-hmm.
Typically for people over the age of 50, 55 or so, interest could be accrued against the loan. So first year you get a loan of 50 grand. Second year, another 50. Third year, another 50.
Yeah.
Loans are not taxed. When you take a loan from a bank, you're not taxed. So in this case, using the corporate policy as a collateral, you're not taxed by accessing that through a loan personally.
Yeah.
Okay. And then, after 20 years, you use the $1 million, but the $1 million inside universal life continued growing, let's say even at 5% or whatever. That's right.
Yeah.
Person passes away, corporation gets the full amount, tax-free benefit from the insurance company. So that's death benefit. Okay. CDA is opened up. Full amount goes to the estate on a tax-free basis.
Mm-hmm.
$1 million is taken to pay off the loan, plus the interest, whatever the interest was accrued. So it could be $2 million, if it's after a long time.
Right. Yeah.
But on a tax-free basis, okay, and the rest goes to the estate tax-free.
So essentially, you're building up an investment portfolio with an insurance on a tax-deferred basis.
Yeah.
Right? And then you take out a series of tax-free loans, which is essentially tax-free income, right, from a third-party bank or whatever.
That's right. Yeah.
And then eventually, when it comes time to pay back that loan at the end of life, you literally can just pay that off with the insurance money.
With the insurance money,
which you receive tax-free as well.
Which estate received tax-free, pays it off tax-free. So essentially,
and then you still receive whatever additional leftover.
Whatever leftover estate receives cash surrender value plus the death benefit.
Exactly.
You see. So essentially, You get it tax-free while you're living.
Yeah.
The loan is paid off tax-free after death, and the remainder is paid to the estate on a tax-free basis.
So IPPs already sounded like a juicy retirement income option, but this is literally a tax-free retirement.
And so
option.
even if you run the numbers against how much you'd be paying, let's say an income tax or any other kind of tax during those retirement years, it still comes out to, even with an accumulating interest from the bank loan, to less than what you'd be overall paying.
Well, keep in mind, let's say, for example, let's go back to the same numbers of $1 million.
Yeah.
And let's say that $1 million is growing at the rate of 5%.
Okay.
And let's say the bank loan for the series of loans is 5%.
Okay.
You're going to borrow $50,000 against your $1 million in the first year.
Right.
Okay. What's your interest going to be? Let's do a quick calculation that first year. At
On
5%.
dollars at
No, on a loan.
Oh, on the loan alone.
Yeah.
For $50,000.
$50,000 at 5%.
5%.
Yeah.
Well, 10% would be $5,000. So
$2,500.
Yeah, it's
Yeah, $2,500. But your $1 million inside the insurance policy, same 5%.
Yeah.
How much is that going to grow? 5% of $1 million,
Yeah.
50 grand. That's the loan. So next year, your insurance portfolio
Yeah.
is 1,050,000.
So it's growing. It's growing at the same time as your interest is.
Is your interest. Now, next year, you borrow another 50,000. Now you have $100,000 loan.
Wow.
So your interest on that loan is 5 grand. It's not 2,500, it's 5 grand. But your $1,050,000, because you're not withdrawing money from there.
Yeah,
That still keeps growing. Your borrowings are
another 5% on that.
another 5%, which is another 50 grand. That's 1.1 million now.
Yeah.
You see, and your loan is 100 grand.
Yeah.
So the loan
Compound effect on the bulk of your money is considerably outpacing in
pricing whatever you're withdrawing.
the annual interest charges that you'd have on your loan, because your loan would very slowly comparatively grow up until the peak of end of life or end of 20 years.
Yeah.
But inside of the insurance policy, because it's so much money, the compound effect takes effect considerably more drastically.
Wow.
So when you think about it, okay, at 5%, you would double your money in 12, 13 years or whatever money you double, right? At 5%. So let's call it even 15 years. There'd be $2 million.
Yeah.
15 years at 50 grand, you're at 750.
Yeah.
So you see, the cash value is still significantly ahead. What the amount of money that you borrowed is.
So your beneficiaries or whoever the corporation wants to pay out that CDA amount to still get considerably more than what they would have paid either in taxes or even in terms of interest. The interest charges compared to what you're growing inside that policy are negligible.
That's right.
I see.
Yeah. Yeah.
So can that loan ever get taxed?
You know what? Any you can use it for any purpose. If you invest the money, then the interest is tax deductible.
Yeah.
So if you don't use it for spending,
Yeah.
if you accuracy of that,
Them into like real estate.
or whatever it is outside of the corporation, anything, any investment
They can reasonably
that has reasonably expected to generate income,
Yeah.
the interest is tax deductible.
Wow. Man, and nobody talks about this
No.
at all. Nobody has like any idea.
It's not esoteric knowledge. Let's put it that way.
It's got to be used by people, but this is a lot of taxation is to many people would feel esoteric, to be honest, because of how complicated the tax codes can be. But this specifically, with regards to tools available to business owners that they can take advantage of, is lesser known.
That's right. So you see, the government is not taxing law. There are certain caveats, there needs to be guarantee fee and stuff like that you can set up.
Right.
For the insurance, but I don't want to go into the intricacies. That's really for the seminar and workshop, to go into the details, how the mechanics actually work. But it's a great way to shelter money from the tax, have it grow tax. If you set up your corporations properly, it becomes creditor sheltered as well.
Yeah.
So creditors cannot put their hands on it. And
Creditors typically can't touch permanent insurance policies. So
creditors generally cannot touch. Now, there are ways, of course, that they can,
Yeah.
But generally speaking, in normal setup, insurance contracts are off limits after 12 months after being set up.
Off limits. Okay.
Off limits for the credit.
Now there's
In both
some kind
cases.
of there was some kind of like 5-year rule as well. How was
5 years if there is a suspicion of fraud when it comes to that. After 5 years, they cannot.
so it's creditor protected after the first year.
After first year or
And
2 years.
5 years.
After proof. That's right.
Wow. Okay.
Yeah.
And that's added benefit of insurance. You have an insurance contract available to yourself in the case of your death.
So the insurance contract has to be used for insurance purposes.
For insurance purposes.
Choose your creditor.
Exactly. And there are calculations for that as well.
That's
to
right.
make sure that it's not an investment vehicle, but that it is.
That's right. But the only challenge is, you see, like insurance typically gets a bad rep because people say, oh, it's such an expense, it's expensive. You got to shift your mindset.
Yeah.
Don't think of it as an expense. Think of it as an investment.
Or at least think of it how you're saving.
No, you can save money because there's a cash surrender value. But think of it as an asset class.
Yeah.
You see, it comes with its tax features, growth features, income features, just like real estate. Real estate comes with,
bonds,
or
right.
any other. Real estate comes with tax features, liquidity features, income
And then
features,
protection features.
That's right, yeah.
Like for actual purpose.
So it's not, it's not all inclusive. It's part of the overall.
And it's not a question of one or another.
One another. It's both.
What works? Yeah, what works in this situation?
Yeah,
So
exactly.
So the kind of, obviously there are a group of people that would be attracted to this type of arrangement. So you'd be pairing an IPP, you could pair an IPP with a permanent insurance product.
That's right. Well, yeah.
Okay.
Yeah. So let's say, for example, if husband and wife operate their business generates, let's say, $500,000 per year.
Okay.
$200,000 per year. It doesn't matter.
Is that profit?
Let's say profit, yeah. Then we need to decide how that money is going to be pulled out outside of the corporation. Dividends, T4 income, whatever it is. Based on that, we're going to figure out the next steps, you see. If it's T4 income, then we can focus on, let's say, IPPs, because that creates room for the IPPs. But let's say if the couple decided to withdraw money as dividends, T5 income, then we need to look at other options. And that's where the insurance actually comes in handy, because the amount of money that you can put in the insurance does not depend on your income in any shape or form.
Okay.
It depends on your insurability.
Right.
You see.
Right.
Mhm.
So if your insurability is high, if you're healthy, then you can potentially put lots of money into that insurance, shelter it from tax. Pretty much it serves the same purpose inside the corporation,
Okay.
like tax-free savings account for individuals.
Okay. I see.
You see, contribution is not tax deductible, but it grows inside on a tax-free basis.
Oh, so you not tax deduct any payments towards an insurance product.
In this case, like there are ways that you can deduct
Okay.
if it's mandated
I see.
for the purpose of the loan, then it becomes tax deductible, but only a portion of it, which is called net cost of the pure insurance.
I see. I see.
Can this ever be used for group plans? This shows us this sort of strategy, borrowing against or anything. Like, could an individual that's a part of a group plan in a corporation borrow against the group policy or no?
If there's a mutual agreement of all the group members,
Yeah.
there's a potential, you see, because in many cases, bank may not be overly concerned,
Yeah.
Who's the person that's borrowing. They may be concerned only with the collateral, which is cash surrender value inside the policy, you see. So I wouldn't set it up as a group. I would set it up individual or joint first to die, joint last to die. So maybe husband and wife as a life insurance.
So you were describing, let's say, husband, wife running the corporation. They have $500,000 in profit annually. You'd advise them to put some of that into an IPP.
Yeah.
With the contribution room that they built. Where would the permanent insurance come in their specific case?
So you see, there's a limit to how much you can put inside the IPP.
Okay.
So let's say, for example, they have both of them withdraw income of $100,000 each.
Okay.
So that's the $200,000. There'd be a calculation for the IPP, how much they can put.
Okay.
Let's use the RSP numbers, which is 18% of that income. Let's say they're 40 years of age. So only $18,000 could go into the IPPs at that point.
Okay.
So think about it. If they take T4 income and they have additional money from the corporation that they put into the IPP or RSP, where's the rest of the money going? $300,000 needs to stay inside the corporation. Let's say $100,000 is for leave it in the business for the business purposes. What are you going to do with $200,000? You can buy real estate. You can put in mutual funds, stock portfolio, whatever you want, but you're exposed to tax.
Right.
So that's where permanent insurance fits.
I see.
You can say, you know what, part of the portfolio, we're going to do, you know what, we're going to take $100,000 per year. We're going to put it inside the permanent policy and go with that.
Yeah. So in that case, that'd be supplementing whatever their retirement income would be from the IPP. You'd be supplementing that with the loans in retirement as well.
With the insurance policy, cash surrender value from the insurance policy. Okay. However you want to figure out, loan is a good way.
Is there a name for that though, with like what you would be doing with the kind of like the loan strategy?
In the insurance industry, when it comes to the retirement in particular, so if you're planning for the retirement, let's say 15, 20 years down the road, it's called insured retirement strategy or insured retirement plan. Okay. But by the virtue of the cash value inside that policy, because people dump money and invest it, you can borrow that money immediately as well.
Okay.
And in that case, from the insurance perspective, it's called immediate financing arrangement, or IFA. You see, so
now where you can
put
pull
it
it out and investing it.
You can pull it out. So you can put money inside the insurance policy, get a loan outside of the corporation against it, use that money to invest, let's say, in a different business. Interest that you would pay here would be tax deductible.
Okay.
But a person needs to figure out and do careful calculation whether it's beneficial or not.
Right.
So everything boils down to proper plan. You see,
there is a proper plan.
And the whole strategy is like, oh, this is great strategy, let's go. No, you gotta see.
One size fits all.
That's right.
Finance.
You gotta see whether it fits you personally. That's where the calculation comes in.
Right.
So those are two strategies. What I would recommend is let's leave other strategies for the next podcast.
Sounds good. I mean, this was pretty loaded, and these few strategies were actually incredible to learn about.
Yeah.
Especially being younger, getting into business with you guys. Who knows? Like life is big. There's many projects that a young guy might want to do. You start a business one day. I know a lot of friends of mine will probably eventually start businesses. Knowing what to do with that money that you end up making is really important. So this knowledge was really valuable.
Instead of just sending 82%.
Sending all of it to the government, and then exactly for what? For I don't know, right? It changes with each government how much you get back. So
That's right.
Yeah.
You should have control over how you're spending your money.
Yeah.
Yeah.
Okay, give me the clap.
No, every time. There we go.
That's good one.
Oh, that was clean one. Let's see. Yeah, brothers can do it.
On more fit.
Okay, a little.
There, a little warm up. There we go. Right.
Thanks for watching, guys.
I don't know what's going to look.